So hopefully everybody can see the slides now. The topics that we're going to cover today are My Pension Online. We're going to talk about your pension calculation and what's included in that, and how we arrive at those figures that we send to you. We'll discuss the retirement ages and how the changes in the retirement ages have impacted the scheme and you and your pension over the years. Protections, different types of retirement, what death benefits will be available for people after you pass on, which I know is not the most cheery of topics for a Thursday morning, but it's important, and I'm sure you'll want to know more about that. I am going to then switch from the PowerPoint to a demo of My Pension Online and just run through the system with you so that you can see what's available in there, and that the information that is available, it will hopefully make it more meaningful to you after you've had a bit of an explanation, so that you know what that information is telling you. We will cover the retirement process, so what to expect, timescales, what's expected from you, what are the sticking points. Again, like I said at the start, really just to put you in the best possible position. And then we're going to look at some common things that we can do to make sure that benefits are paid on time and efficiently. So just an introduction really to My Pension Online at this stage. We will get a bit more hands-on with it later on and have a good look around the system. But if there's anybody here who isn't yet signed up to My Pension Online, and I appreciate that there is a pension fund who doesn't yet use My Pension Online, and that pension fund is Newham. So if there is anybody here from the Newham pension fund, apologies, I know that you can't use this at the moment, but everybody else should have access to this system. But if you are not signed up to this system and you are not in the Newham pension fund, then it means that you are not seeing the information that we want to share with you. So that's things like your annual benefit statement. You're not able to see who you've nominated for your death benefits. You're not able to run your own pension estimates. So there's some really key benefits to being registered for this portal. So I think the advice is, even though we're not supposed to give you advice, but the advice with this would be that if you are not registered, please do get signed up, and it will make that process smoother for you in terms of the information that you can get from this system, putting you in the best possible position to navigate your retirement. So we're going to start to look at the scheme now and understand a little bit more about how benefits are calculated and what things impact on the value of your pension. Probably safe to say that most of you already know that it's your pay and your service that impact on the value of your pension. So when we are calculating your benefits, it's specific and unique to you in terms of your service history, membership of the scheme, and your salary, and how that salary may have altered over the years. So what I'd like from today really is for you to go away understanding a little bit more about that, in terms of how your information impacts on the value of your LGPS pension. So what will your LGPS pension be made up of? So there's three components there. The first one is final salary benefits. So that's for anybody who was in the scheme before 2014. So before April 2014. If you joined after April 2014, then you won't have a component of final salary benefits. You will have just joined the newer part of the scheme that became available after that. Any transferred in membership that you may have brought with you when you joined. So what's quite common is that when people join the scheme, they have existing pension benefits in other places from other jobs or perhaps private pension arrangements, and quite often they want to transfer those into the scheme, and there is a time scale in which you can do that. So, you know, you people here today may have done that when you joined, and if you did, that will be reflected in the calculation. You can also check that on My Pension Online. It will show you the transferred in membership that you brought across. So that's good just for you to be able to see that. And then there's the care pension, which is the pension benefits that we built up from the 1st of April 2014 onwards. So those of you that were in the scheme before April 2014, you will have a component of final salary pension and a component of care pension, and the two are added together, along with any transferred in membership. And probably what's missing from this slide actually is any additional pension that you may have purchased. So not everybody does that, but some people set up an additional pension contract at some point in the lifetime of their membership, and they can do that in one of two different ways, either an AVC or an APC, or actually both. You can have both of those arrangements in place at the same time. So if anybody had those arrangements, obviously that's going to be included in your pension as well. We'll talk about that in a little bit more detail later on. But all of those things added together make up your LGPS inflation proofed pension. So we say that it's inflation proofed because what that means is whenever there's a rise in inflation, your pension benefits will rise as well, and it's linked to CPI, so Consumer Price Index. So for those people who were in the scheme pre-April 14 and have an element of final salary membership, I just want to give you a bit of a better understanding of how that part of your membership is calculated. The things that we'll be looking at when we calculate that part of your membership is your final salary. So as the name suggests, it's linked to your final pay. So what do we mean when we talk about final pay? What we mean is your final 365 days worth of pay scaled up to full-time equivalent. So anybody who is a part-time worker or maybe has done periods of part-time working, it's always the full-time equivalent salary that we use for the purpose of calculating your final salary benefits, regardless of the hours that you work. In most cases, it's the last 365 days, but there are a couple of exceptions to that rule. One of the exceptions is if you have had a higher year within the last 3. So we call that best of the last 3 years. We can default to one of those higher years automatically, and your employer would give us that information when you are retiring. The other scenario, I suppose, where it might not be your final 365 days is if you have had something, if you've been through an exercise similar to a restructure or anything really where you've accepted a lower paid job in order to remain in employment with the same employer. So this is, I suppose, not if you just chose to take a lower paid job. This is if you sort of had to do that in order to remain in employment with the same employer. So the most common scenario there is restructure. So if you are somebody who was negatively impacted as the result of an exercise like that, and you took a lower paid job, then there is a protection in the scheme for you, which says that we can look back over the last 13 years and use the best 3-year average within that 13-year window. So you'll know if that's you and you're affected by that. there is an option on the retirement forms to indicate that you think that that option extends to you. And then if that's the case, we would automatically request that information from your employer and make sure that your pension benefits are calculated using that method. Just be aware though that a reduction in hours wouldn't put you in that category, because a reduction in hours wouldn't necessarily mean that you're on a lower full-time equivalent rate of pay. So it is specifically a situation where you've accepted a lower full-time equivalent rate of pay in order to remain in employment with the same employer. But in most cases, we're looking at the final year of your employment, which is normally the time that you would expect to earn the most, luckily. What we then need in order to calculate your final salary benefits is your pensionable service. Now, your service is the service that you've built up where you've paid into the scheme, so you were a member of the scheme during that period of service. So obviously, if you've had periods where you opted out, that will not be used in the calculation. And your service is prorated. So if you are a part-time worker, then your service will be scaled down to reflect the part-time working, but it will include any transferred in service that you brought with you when you joined. What we then need is an accrual rate in order to calculate your pension using your final salary figure and your pensionable service. Now, in 2008, the government made some changes to the scheme at that point, and what they did was change the accrual rate from an 80th to a 60th. So again, where we've talked about people having membership pre and post April 14, we're also here kind of saying, well, anybody who was in the scheme before April 2008, there's almost three components to your pension. There's the 80th accrual benefits, the 60th accrual benefits, which runs up to 2014, and then you've got your post April 14 benefits, which is the career average membership, which we'll talk about in a minute. But just thinking about final salary pension, there are two potential parts to that depending on when you joined: your 80th and your 60th benefits. Some of you who've been in the scheme a long time will be familiar with these terms, 80ths and 60ths, and some of you will may be familiar with it and think, I don't know what it means. I certainly didn't know what it meant before I started working in pensions. So hopefully you'll have a better understanding after today. But don't feel that you need to understand the minute detail of what I'm explaining here. I really just want you to understand that your final salary and your service will be the things that impact on the value of your pension when you retire. But this is just a nice to have, really, to understand the mechanics of it. So when we calculate that pension, we'll be putting your service over your accrual rate and multiplying it by your full-time equivalent rate of pay. So in this example, this person has got 5 years under the 80th scheme, 6 years under the 60th scheme. We multiply that by 20,000. That gives that person an income at retirement from their final salary membership of £3,250 a year. And that would be guaranteed index-linked income. So it would be inflation-proofed. It would be £3,250 now, but in 10, 20 years' time, it would have had inflation added to it, so it would be worth a bit more. The idea behind that is obviously, if it buys you a loaf of bread and a pint of milk in today's money, it should still buy you the equivalent in the future. Now that £3,250 is based on being paid to that person at their normal retirement age. Normal retirement age under the final salary scheme is 65. So if you are going earlier than 65, there will be a reduction on your final salary pension. They call that an actuarial reduction, and we use a factor that's given to us by the government in order to calculate those reductions. I am talking about the two parts to the scheme as though they're different, and they are in a way, but just to be clear, when you get your pension, it's one payment, and the final salary pension and the care pension, which is the newer part of the scheme, are always, well, in most cases, paid together as one payment, and they're just calculated using these individual methods. So that's the final salary pension. What we have then is the care pension, and the care pension is the scheme that was brought in on the 1st of April 14. CARE is an abbreviation for Career Average Revalued Earnings, so that's the full name for the scheme. We still call it the new scheme, but it's not the new scheme anymore because it's been around since 2014, but old habits die hard, I think. So we should call it the current scheme, not the new scheme. So the current scheme is a lot simpler to explain. It builds up based on a 49th of your gross pay. So basically, whatever your gross pay is in any given period, if you divide that by 49, which is the accrual rate that every member benefits from in the LGPS, regardless of where you are in the country, it's the same for everybody in the scheme. So if you divide your gross pay by 49, that tells you how much pension you've built up in that period. For example, if your gross pay in a year was 25,000, divided by 49, that comes to £510.20. So for 1 year of membership on a salary of 25,000, your income at retirement would be £510.20 a year. Every year for as many years as you live. Again, it's guaranteed index-linked income. Again, it's based on being paid to you at your normal retirement age though. So if you do take your pension early, then there will be a reduction placed on that amount of money to reflect the fact that you're taking it early, but you will receive it for longer. So you'll receive that money more times over your lifetime. So just to be clear here, we're not talking about full-time equivalent rate of pay. It's gross pay, it's the pay that you receive in every pay period. So for those of you that do overtime or have different allowances in your pay, basically anybody whose pay is likely to change from month to month, your pension accrual will also change in line with that gross pay, because it's always a 49th of what you earn. So we add those two parts together, your care pension, your final salary pension, and you receive it as one payment. Probably just to mention here as well, there is the option to take a tax-free lump sum from the scheme, which I'm sure some of you know already, and if you've been looking at your benefit statements, you'll see that some of you will have an automatic lump sum on there already. So anybody who was in the scheme before April 2008, when you look at your pension forecast, whether that's online or using your benefit statement, you will see that you have an automatic lump sum figure already. That's because at the time, the scheme came with an automatic lump sum, so you built up an automatic lump sum with your membership. From 2008, the automatic lump sum was removed, and there was a change to the accrual rate when it went from an 80th to a 60th. Now, even though the automatic lump sum was removed, the accrual rate actually got better. because if you've got a 60th of something, you've got more than if you've got an 80th of it. So it wasn't necessarily a negative change. Regardless of whether you have membership before April 2008 or not, you will have the option to convert pension into lump sum if you wish. So everybody, regardless of when you joined, will have the option to convert some of the income that they have built up into a lump sum. I've probably already covered this really, the retirement ages, but just to say that the normal retirement age in the final salary scheme is different to the normal retirement age in the care scheme. So the final salary one is 65, the care scheme is state pension age. But the minimum retirement age for anybody who's in the scheme now is 55. So anybody who's an active member of the scheme can draw their pension from 55. You don't need your employer's permission to do that. You will receive a reduced pension over a longer period of time. And what you can do is find out by logging into your online account what that pension looks like and what those amounts will be if you take it early. So we've got an example here. Mrs. Smith has been a member of the scheme from October 06 to the 31st of March 2030. So we're obviously in the future here. She retires at age 66. Her state pension age is 67. So her final salary membership would be adjusted because she is leaving later than 65. She's going at 66. So she's going to have an extra year of final salary membership because the normal retirement age was 65. Her care pension will be adjusted because she's going earlier than 67. So there'll be a year reduction on her care pension. So the reductions are applied on an individual basis so that you don't lose out as a result of the changes to the normal retirement age that came around in 2014. Some of you will have come along this morning thinking about the 85U rule. It's a question that always crops up when we talk to people about retirement. Certainly when we talk to people who've been in the scheme for some time, because it was a protection, or is a protection, that exists for people who have a lot of service. Now, the 85U rule is being phased out, so eventually it will disappear. People like myself will never benefit from the 85U rule, but for those who've been in the scheme quite a long time at this point, you may benefit from the 85U rule. There is obviously criteria that needs to be met in order to benefit from that protection. But essentially what this rule does is it allows you to be protected from some of the reductions that would normally apply to your pension in an early retirement situation. So if you are somebody who's going at 60 and your state pension age is 67, so we know now that there would be a 7-year reduction on your care pension because your care benefits are linked to a normal retirement age of state pension age. And it's that reduction that the 85U rule would protect you from, so that the penalties are not applied to the pension to reflect the fact that you're taking it early. Now, it doesn't mean that you'll receive the same pension you would have had if you stayed paying into the scheme until state pension age. You still get a pension calculated up to the day that you leave, but it just means that the reductions that would normally apply do not apply if you have this protection. Now, the level of protection that you have depends on your date of birth, and there is a table which has been provided by the government that we have to follow, and depending on your date of birth depends on the level of protection that you've got. So that information can be found online if you want to look at it. But basically, the earlier that you were born, the more protection you tend to have. So for somebody who might have full protection, they might be protected on their 80ths, 60ths, and 49ths. For somebody who's got sort of mid-level protection, they might just have protection on their 80ths and their 60ths. Somebody, again, who's a bit younger, but still meets the criteria, might just have that protection on their 80ths. But regardless, it's still a good protection, because even if it's just on your 80ths, if you meet the 85-year rule, it means you've got quite a lot of service. So your 80th is going to be quite a chunk of that service, your pre-08 membership. So the criteria for the 85-year rule is that you joined before April 2006. Your age and your service added together need to add up to 85. So if you are 60 with 25 years service, and that's calendar years service, so even if you were a part-time worker, a year counts as a year, it doesn't matter that you were part-time, then added together that would be 85, which would potentially give you that protection, but it just depends on your date of birth. When you receive your retirement figures from us, when you get your retirement pack, there will be a calculation sheet included in that, and on the calculation sheet it will show you any reductions that have been applied to your pension. If you are going early, so let's say you're going at 60, but there are parts of your pension which haven't been reduced, for example, if your 80th benefits aren't showing as having a reduction, then it's safe to say that you've got the 85-year rule protection, because ordinarily they should have had a reduction placed on them. So that's how you can check that it has been included. But the 85-year rule is included in any figures that you run online and any figures that are sent from us. There is another protection in the scheme called the underpin protection. Now, the underpin protection was brought about with the introduction to the new scheme in 2014. I just called it the new scheme again, the current scheme in 2014. And the criteria for the underpin is that you had to be active on the 31st of March 2012. You had to be 55 or over on 1st of April 2012. You had to be active on the 31st of March 2014, active on or immediately prior to the underpin date, which is the 2012 date, and not have a disqualifying break of 5 or more years from membership of any public service scheme. Now, the underpin, you're probably thinking, what is the underpin? The underpin is a protection that the government brought in with the changes to the scheme, because there were obviously people when those changes came around who had made plans based on the retirement figures that they were looking at, based on membership in the final salary scheme. And some of that may have changed as a result of joining the new scheme. So the government felt there had to be a protection for those people. So those people should be the people that meet that criteria. So essentially they should have been within about 10 years of retiring. And what the underpin allows is for the value of the pension to be increased if it is less than the pension would have been if you had not transitioned into the new scheme. So we do a comparison of your pension based on you being in the final salary scheme only and based on your combined membership of the final salary scheme and the care scheme, and then if it's identified that you are worse off, the difference is made up. Now, there are some challenges in public sector pension schemes at the moment, which some of you may have heard of, which is the age discrimination case, which was brought about by a member of the firefighter pension scheme and a member of the judges pension scheme, and they challenged some of the protections that were brought about to public service pension schemes when there was pensions reform around 2014, 2015, and their challenge was upheld. So it means that some of the decisions that were made then they're having to be undone, and we're having to look at, or the government's having to look at, a remedy for that challenge. So the firefighter and police schemes are a bit further along with that, but the local government scheme is one of those schemes that are affected, and I imagine, or it's thought, that the way that that remedy will be applied to the local government scheme is by looking at this underpin, because this is the part that probably could have been interpreted as age discrimination. So there could well be recalculations on the horizon for some people. If you have already left and you are one of those people, please don't worry. All the historic cases will be looked at. So we will go back and look at anybody who was affected by that age discrimination case, and if there is any additional pension to be awarded to you, you will receive it. What ways can you retire from the local government pension scheme? Early voluntary retirement, which we've talked about, so that's from 55. You'll get a reduction placed on your pension, but you don't need your employer's permission if you are 55 or over. You can retire late, so you may want to keep working beyond your normal retirement age. Not many people want to do that, but some people do. So the maximum is age 75. So at 75, whether you are working or not, you need to be taking your LGPS pension. There's flexible retirement. That's normally an option that people are quite interested in. So with flexible retirement, it's allowing people to sort of transition into retirement at a bit of a slower pace, rather than going from full-time working and then overnight into full retirement. That can be a bit of a shock. There is a flexible option, but the way that each employer allows people to retire flexibly is different. So you do need to refer to your employer's process. Your employer will have a policy in place which sits with the HR function normally, in terms of how those flexible retirements can be done and considered and carried out. But typically what would happen in a flexible retirement situation is from 55, so you still have to be 55, you could reduce your hours or your pay grade, you could continue working at that lower grade or on those less hours, and you could be claiming the pension that you've paid into up to that point. So the pension value as it is at that point, you do your reduction, you continue working on that reduced basis, and you've obviously got your income from your reduced working and your pension as a bit of a cushion during that time. Then when you retire fully, your pension continues, that doesn't change. And what may have happened is you may have built up an extra record of membership from the work that you've done on that reduced arrangement, and that would come into payment as well, and it would supplement the pension that's already in payment. So as I say, it's always of interest to people, that one. It is quite an attractive option, I think. but you do need to discuss it with your employer. For the purpose of the scheme regulations, it states that it's an option and it can be considered, but it also states that each employer needs to have their own policy on it. So do take that up with your employer. The other option or the other scenario that may occur is redundancy or efficiency retirement. Now, redundancy or efficiency retirement, again, requires the member to be 55 or over. And we're not saying that you have to be 55 to leave your job on redundancy, but in order to benefit from a redundancy retirement, you would need to be 55 or over. And what that means is that the pension benefits are paid to you immediately and on an unreduced basis. So the reductions that would normally apply to somebody leaving early wouldn't apply in that situation. So a little bit like the 85-year rule, it's a protection. Anybody who's under 55 and leaves on redundancy, the pension benefits are not protected. They are just deferred like they would be for anybody leaving at that age, and they will be available at a later date to you. With redundancy, it doesn't matter if it's compulsory or voluntary, it's done on the same basis. And then there's normal retirement, which is just retirement at state pension age, and there's no reductions, there's no enhancements. In terms of death benefits, there are two different parts to the death benefit provision. Depending on when you die, depends on which elements of this will be available to somebody. It could be that one of them is available, it could be that both of them are available, it could be that none of them are available. It purely depends on circumstances, and I'll explain that now. With a death grant, which is the first one there on the left-hand side, with a death grant, there is a little bit of it's like a life cover policy really, which is for anybody who might die as an active member of the scheme. Now, hopefully that will not happen to anybody here, but if it did happen, there is a life cover element of 3 times your salary. So if you die as an active member of the scheme, 3 times your salary will be payable to somebody as a policy, a bit of a life cover policy. It's a protection, essentially. It's one of the benefits of the scheme. If you die within the first 10 years of claiming your pension, then again, there's a bit of a protection that exists there, where we say, let's look at the amount of pension that you would have had over 10 years, and the balance of that 10 years that you've not had is paid as a lump sum. So if you were to die in the first 5 years, after having received 5 years worth of your income, there's 5 years worth of that 10-year guaranteed period left. So that would be paid as a lump sum to somebody. That's up to a maximum of age 75. Regardless of which of those scenarios may occur, we do ask that you make an expression of wish so that we know who that money should go to in the event of your death. It's really important that you make an expression of wish, and that's because if you haven't made an expression of wish, then it means that we have to make a decision in terms of where that money should go. It means that we might have to liaise with your pension fund, and they may have to make a decision. And what can happen is that it lengthens that process. So the processes that we were just talking about earlier, we obviously want to keep them as small in terms of timescales as possible, because essentially what it means is that somebody's waiting for money. The longer that these processes take, the longer that somebody is waiting for their income. And in the case of a death grant, it might be that a loved one is waiting for that money because they really need it. So having an expression of wish just means that we can be as efficient as possible in that scenario. You can nominate anybody you like for your death grant. It doesn't have to be a family member. It can be a partner, a spouse, a child, a relative. It can be a friend. It can be a charity, an organisation. It can be absolutely anybody. It's up to you. In the absence of an expression of wish, we would have to make that payment very carefully in line with the rest of your estate, really. So we'd have to be guided by solicitors, and like I said, it is a more complicated process. The other death benefit is a survivor's pension. Now that's payable to a widow, a widower, a civil partner, a cohabiting partner, or a child. In the situation of a child, it's normally if that child is under 18, so they'd be classed as a dependent. So we would be able to pay a survivor's pension to that person. It says cease at 23. That's for anybody who might still be in full-time education at 23. So they would have to remain in full-time education to be eligible for that survivor's pension, up to a maximum of 23. Otherwise, it would stop at 18. With a cohabiting partner, there is criteria that has to be met. So it's things like, have you lived together for 2 years? Have you been unmarried to somebody else for the last 2 years? Can you provide evidence that you are financially linked in some way? So something like a joint mortgage or a tenancy agreement. But we would be asking the surviving partner for that evidence in the event of your death. And obviously widows and widowers, civil partners is fairly straightforward. There's normally a legal arrangement in place there, evidence of a ceremony of some kind. I'm now just going to show you my pension online, because I think it's better to do it at this point before we just move on to the retirement process, because it's quite key to the way that your benefits are calculated and looking at your lump sum and that sort of thing. So what I'm going to need to do now is just unshare and reshare my screen. Okay, this is the Local Pensions Partnership Administration website. So this is our website for you, for our members and our employers. And it's the one-stop shop really for all of our members, regardless of which pension fund you may be associated with. You can see down here that it indicates all of the pension funds that we work with. And towards the end, some of the blue light ones as well, the fire and the police schemes that we administer. In terms of accessing my pension online, there's a very clear navigation up here at the top, which says access my pension online. What you would be looking for is to log in, or obviously if you have already logged in, if you've never logged in before, then you'll need to create an account, which you can choose register, or maybe you've registered and you've had your activation key, but you need to just complete your registration using that key, then you would choose the third option. But we'll imagine today that we're already registered. You choose which pension fund you are in and you select go. Then it will ask you for your username and password. And what I'm going to use is some test account details, but the account will look exactly the same as your account looks. Okay, very straightforward system to use. I think it's intuitive and it's very clear what each part of the system does. The thing that you might have questions about is the information that's available in there about what it actually means. So I think that's one of the benefits of just going through it. So the first tile here is my details. That's fairly self-explanatory. It's your personal information. You can change your home address or your email address on here. Scheme membership details is broken up into two parts. Service details, so it gives you almost like an audit trail there of your service throughout your membership of the scheme. What you might see is multiple entries for the same employer. Can you see here that this one has Lancashire County Council entries multiple times? Now, what that means normally is that that person has changed their working arrangement or pattern. So if there has been a change in hours or a change in contract, fundamentally something has changed, then those will be listed here as individual entries. Financial details, so it will confirm your basic contribution rate and your pensionable pay at the moment. Your pension benefits are always calculated on your pensionable pay as it stands now, because we can't obviously predict what might happen to your pay in the future. So with the care benefits, it's not such an issue because they're building up based on a 49th of what you earn every month. So they're already in the bank, really, so to speak. But with the final salary benefits, they're all calculated on the pay that you earn right at the end of your membership. So we never really know what that pay is going to be. But as you get towards your last few years, we have a good idea what it's going to be, unless something dramatically changes in your last year. In the pension benefits section, this is probably the most useful part for you as a member. You're able to actually do your own pension estimates. So we go to benefit calculators, and there are options in terms of what type of calculation we want to do here. There is a deferred benefit calculator, which is if you want to understand what the benefits will be worth in the future if you leave the scheme now. So not if you retire, but if you just leave the scheme. The pension payment calculator is for a retirement, which is either early, on time, or late. So early is 55 plus. On time, I mean, on time is probably not the right phrase, but state pension age is what I mean there. Or late would be anything up to age 75. So all those scenarios are covered within that pension payment calculator. You've got the option to run an ill health estimate. There is provision in the scheme for ill health retirements. Those are very much led by your employer. So you would need to consult your employer if you think that an ill health retirement is something that applies to you. And it depends on the level of that illness and your ability to work again in the future. And it would that information would dictate what level of ill health you would be awarded. But for the purpose of calculating that information, the calculator lets you do a tier 2 estimate, and there's 3 different tiers potentially available. It allows you to run a death benefit estimate, which is just you forecasting the value of the death benefits that would be payable in the event of your death. And there is also a redundancy retirement option as well. So again, that's just indicative. It's really up to your employer, if you're in a redundancy situation, to obtain an estimate for you, which they would do from us. Probably the one that we're all interested in, I think, would be the pension payment calculator here. So you can see, I'm going to go to the bottom of the screen first, actually, because I think it's the wrong way around. I think this should be at the top. But at the bottom of the screen, it asks you the pension start date. So that will default to your state pension age, because that's the date at which your benefits will be payable with no reductions. But you can change that date to anything that you like, as long as you are 55 or over on that date. If you do change anything in these boxes, you have to press calculate over here, and that will reset the figures that are at the top of the screen. We've got two different definitions of pay here. We've got care pay and final salary pay. If we go right back to the beginning of the session, we looked at the two elements to the scheme, the final salary and the career average part. And what we should understand now, to some degree, is that there are different definitions of pay within those two parts of the scheme. So the final salary pay is full-time equivalent pay earned in the last 365 days of employment. It's normally your basic contractual pay only. It doesn't include things like overtime. Your care pay is your gross pay that you earn in the month and throughout the year, and that can alter month to month depending on your working pattern or any allowances or pensionable extras that you may receive. So for some people, those figures will be different. For somebody like myself, I work the same hours and my pay is the same every single month. So really, those figures should be pretty much the same. Once you're happy with that information down there, and you can change it if you need to, you've pressed calculate, go back to the top, it tells you the annual pension that you will receive based on that information at the bottom of the screen. So for this example, it's going to be a pension of £12,904.31 a year. This person has obviously got an automatic lump sum. So this person clearly has quite a chunk of pre-2008 membership, because they've got quite a significant automatic lump sum in that field. For somebody like myself who joined the scheme after 2008, there will be zero in that column. I will not have an automatic lump sum. But as I said earlier, the options for generating a lump sum are the same for everybody. And you can find out more information about the lump sum here in the next section. On this bar here where it says minimum and maximum, you can click and drag, and what will happen is the lump sum will begin to increase from where it currently is. So for this person, it's currently at 22,773.92, but yours might be at zero. Regardless of, you know, what it says in that box, it doesn't matter. Everybody will be able to click on here and drag until you reach your maximum lump sum amount. In this case, the maximum lump sum is 63,437.72. And what that does is it reduces the income from £22,773.92 to £9,515.66, because you are choosing to convert that pension into a lump sum, a one-off payment. And then the pension will be a reduced amount for the duration of the time that you receive it. So for as many years as you receive it, it will be that reduced amount because you've had that upfront payment. The lump sum is normally tax-free, but it just depends. In some cases, there can be a taxable element to it. If you've got an AVC and you've put quite a lot of money in that AVC, it can mean that there's a little bit of a taxable element to the lump sum. What you are doing there is exchanging some of your pension for lump sum at a rate of 1 to 12. So for every £1 that comes off the pension, it gives you £12 in lump sum, up to a maximum amount. That maximum amount is 25% of your overall LGPS pension. But this system will always tell you what your maximum amount is. So that's probably the most useful part of the My Pension Online portal, I would say. There's an option within that same section called Latest Valuation, which allows you to just see the amount of benefits that you've built up to now. And really those figures are based on the membership that you have so far. And the scenario here is if you left the scheme today and took the pension at normal retirement age, that's what the figures would be worth. But obviously, unless you're doing that, it's not really relevant, but it's just interesting to see how much you've built up so far. What you can actually do is click on the care benefits here, and it will give you a breakdown of the amount of pension that you are accruing each month. In the documents section, there are two parts, the scheme documents and my documents. Scheme documents are generic information that's the same for everybody. Things like your newsletter each year, guides to understanding your annual benefit statement, things like that. Whereas the documents that are specific to you, like a pension estimate, for example, they are published within my documents. We've then got nominations. So we've talked about nominating and how important that is. You can do your nomination directly onto this system. So whether you're nominating a spouse or a child or somebody else, it can all be done on here. Under the My Settings section, you can change your password, change your security responses. You can withdraw your consent to using the online portal. There's useful links in here which might be of interest. And you can also submit a question via the Contact Us form as well. There's two ways to submit a question. You can do it through this portal, or you don't need to be logged into the portal. On the generic website, there's a Contact Us section here, and there's a contact form there, which you can fill in if you need to. And that's the online portal. So hopefully that's been useful. Just want to go back now to our slides. When you receive your retirement options from us, this is what you will see, a document like this, where the numbers will be there for you to clearly see and make a decision around what lump sum you want to take. What this document illustrates is the automatic lump sum and the maximum lump sum. It doesn't give you the figures in between, but what it does do is it tells you underneath how you can work that out using the formula. So for every £50 of pension that you commute, it will give you £600 in lump sum. For £100 of pension commuted, it will give you 1200 in lump sum, and so on and so forth. But you can just go online and use the calculator to make life easy. On the website, there is a full breakdown of the retirement process on the Getting Ready for Retirement page. I think it's useful to look at that in advance of your retirement, because it's just about putting you in the best possible position, and it will serve as a recap probably on a lot of the things that we've talked about today. But one of the key messages from us is that the more notice that you give your employer, the more chance we have of paying you on time. So if you can give up to 3 months notice to your employer, that's ideal, because it means that we can start preparing the figures, we can get your estimate out in the post, you've got a bit of time to look at that estimate, make some decisions, fill the form in, and return that retirement pack to us. And then as you actually eventually leave, your employer will give us your final pay information, and we can release your benefits so that they're ready for you the following month to the month that you left. If you tell your employer 30 days before you finish, it doesn't allow a lot of time for that whole process to happen. Now, I know that people have notice periods that they need to work to, and some people are comfortable working within those parameters. But if your notice period is a month, in a retirement situation, it's a little bit different to leaving and going to a new job. There's no reason you can't tell your employer a little bit earlier. 3 months is ideal. For those of you that have an AVC, that can delay payment of your pension by up to 2 months, because there's more people involved in that chain, because the AVC is administered by a third party. It's an investment product done by Prudential in a lot of cases, but not everybody's will be Prudential. And what we have to do is contact the Prudential, ask them to disinvest the fund, release that money to us. We then need to work out how much tax-free cash you can take. So, again, there's a lot more involved in that process. So one of the things that you can do if you want to avoid that delay is you can cancel your AVC in the last month. So the before the cut-off for your last payroll with your employer, you can ask them to stop your AVC, which will minimize that delay, but it may not necessarily remove it completely. But obviously that's up to you. You may not want to do that because you may want to get as much tax-free cash into that AVC as possible, but you just have to be comfortable with the delay. What can we do to get your benefits paid to you on time? So make sure you're online with your pension and you can start looking at your figures as early as possible. Give your employer as much notice as possible. If you've got an AVC, be aware that that can delay your pension. Carefully fill out and return your retirement options and check that you have provided good quality photocopies of any certificates we have asked for. Now, at a minimum, we'd be asking you for a good quality photocopy of your birth certificate at retirement. So if you know that that's going to be a problem, you can get in touch with your local registry office or the registry office that your birth was registered at, and you can obtain, you know, a copy of that. So that's something you could do in advance. If you want to, you can submit evidence of your marriage at the point that you retire, which just means that when something happens to you, or if something happens to you before your spouse or your partner, we've already got that evidence on file, but we don't need it at that point. You know, your partner could provide it in the event of your death. Double check that all sections of the retirement pack are completed correctly. I'm just going to show you the retirement pack actually. Just so that you've got an idea of what to expect. When you receive your retirement paperwork from us, this is what it will look like. Please don't be daunted by it. It's not a lot of information that we're asking for. Your personal details, your marital status. There will be a copy of the retirement figures which I showed to you an example of earlier. So that will be there so that you can look at how much pension you want to take in line with the lump sum that you want to take. So you indicate on this form which option you want to do. I mentioned at the very start that there is some protection in the final salary scheme for reductions in pay. This is where you would indicate that you feel you meet that criteria. Then we get into HMRC information. Now, it's a requirement when you retire that we ask about any other pension benefits that you have, and it's specific to ones that came into payment after or before a certain date. So it will clearly outline which benefits we need to know about. So I would say, in preparation for retirement, can you find out about what other pension arrangements you have? Are you in receipt of a pension already from another job or from another private pension arrangement that you've had? Find out, you know, what the value of that pension is. And we're particularly interested in something called the lifetime allowance. So every time you claim a pension, it uses up a percentage of your lifetime allowance, and everybody has got a lifetime allowance. And what it is basically is the amount of money that you're allowed to have in retirement benefits. It's a large amount, so you know, unless you have an extortionate amount of pensions, it will never affect most of us. But we do have to measure it for HMRC purposes. So please have details to hand of any other pension arrangements that you've got in payment or maybe coming into payment at a later date. And on the documentation for those pension arrangements, it will give you the lifetime allowance percentage that has been used if they are already in payment. So lifetime allowance is something that's captured and measured at the point that pension benefits come into payment. So any pension benefits that are already in payment, just, you know, make sure you find out what percentage of the lifetime allowance is currently being used, and maybe the value of that pension would be handy to have in preparation for this retirement pack coming through. You'll need to give us your payment details, so the bank account that you want us to pay you into. You'll need to sign a declaration. There's a form of election which needs to be filled in, which just confirms that you definitely want to take your pension now, or you want to leave it and receive it at a later date, or you want to receive it at your normal retirement age. There's a section here on GMP, which is if you are choosing to defer your pension and not take it, there is a guaranteed amount of pension that the government states that you have to have from a certain age, and it is linked to your state pension in a way. So it might be that we have to release a certain proportion of your pension once you reach a certain age. But if you are drawing your pension as soon as you leave, that you know, we don't need to worry about that. Your GMP will be included in the figures already, and you'll need to sign and date that declaration form. And that's actually the end of the form, so it's not too bad. Do make sure that you've got good quality copies of certificates available, so your birth certificate if possible. And again, it's all just about making sure that that process runs as smoothly as possible. Okay. We've got some questions in the chat. So I took less hours, but on the same pay band due to restructure. Does that affect the prorated pensionable service? For anybody who's experienced a reduction in pay, indicate it on that form, and we will look at that. So the regulations are quite complex in that area, so we would need to check that, but just indicate it on the form, and we will look at that for you. To my knowledge, it's when it affects your full-time equivalent rate of pay that it offers you that protection. But really, essentially, your earnings have been affected. So there could be some protection that exists there with the service. I'm not 100%, to be honest, but I can actually get you an answer, Angela, and come back to you on that one. What constitutes a pay period is a month normally. How accurate are the online projections? They're based on the information that we have from your employer, and it's as up to date as that information is, basically. So unless your pay is going to drastically change, then you can rely on that information to make a decision. What is the reduction figure? The reductions that apply are given to us by the government. That you can find them on our website. If you want to have a look at the scheme guide, there'll be a table of reductions in there. But basically, for every year early that you go, there is a percentage reduction applied to the pension. Is the after retirement death grant paid even if you retire early? Yes, so even if you go early, if you were to die within the first 10 years, that guaranteed pension amount is still payable as a lump sum. What does SIB review mean? It depends in what context. Is that something that we have asked you about, Jane, or is it something from DWP?
Hi, yeah, when I go on my service details, it shows that I've been in the LCC pension and Blackburn with Darwin pension, and then there's other details from 1991 where it just says next to it SIB review.
SIB review.
Under service details.
I'm not sure actually, but we can take that one away for you if you like and find out.
Yeah, if you would, that'd be great, thank you.
No problem. If you have previously deferred pension, does the calculator include that with your current live pension? No. So what you would need to do in that case is when you are logged into the portal, if you go up to the top, there's a drop down arrow which allows you to toggle between your records. Can you take more pension and less lump sum? No, you have to take the minimum automatic lump sum that's available. But you can obviously increase the lump sum and reduce the pension. David, can we request the retirement pack more than once? Yes, if you want to, absolutely. Does service mean years with employer or years in the scheme? Service, actually, I know it's a little bit misleading. Service is years in the scheme, so it's membership. Is there a benefit to retiring at the end of a tax year? I mean, regardless of when you finish, if you're going part way through the tax year, obviously your tax code at that point will be based on your earnings as they are at the time from your employment, and it will probably mean that you might pay too much tax for the first month or two until the tax code levels itself out with HMRC. So that will probably happen. But I think that, you know, that would still be the case if you finish at the end of a tax year. I don't think that really would be any different. So in my opinion, there isn't really a benefit. It's more about the date that's right for you. Can you leave the pension scheme before retirement? Yes, you can leave the scheme anytime, and if you are under 55, your pension benefits will become deferred. And if you are over 55, you can still leave the scheme and defer them. The only requirement is that you must take them at 75. That's the latest date that you must take them. How do you leave the pension scheme? You fill out an opt-out form which is available on our website, and you give it back to your employer, to your payroll department. What evidence do you need for a cohabiting partner? You need a copy of a linking document, really, like a joint tenancy or mortgage agreement or a council tax bill, something like that. You need evidence that you have been unmarried to anybody else for the last 2 years. What else? And evidence that you've lived together for the last 2 years. But that evidence is provided at the time of your death, because otherwise, obviously the situation may change. It's always looking at like the last 2 years. So you don't need to provide anything now, but obviously if you wanted to be sure that your partner could provide that evidence, those are the things that we're looking for. Evidence that you're not married to anybody else, that you haven't been married to anybody else for the last 2 years, evidence that you are financially linked in some way. The bigger the lump sum you take, is your reduced pension only payable over a maximum period? No, so the reduced pension is payable for the rest of your life. Taking into account, apologies about the dog in the background. Taking into account ABCs, is there a limit to what can be taken as a lump sum tax-free? Yes. So when we look at how much tax-free cash you can take, it's 25% of the overall value of your LGPS fund. When you've got an AVC as well, what we have to do is add in the value of that AVC to that overall value of your LGPS pension, and then it becomes 25% of that combined value that can be taken as a tax-free lump sum. We can't do face-to-face appointments, unfortunately. We did used to offer pension surgeries, but what we've replaced that with now is a scheme essentials presentation every month, similar to this one, but it's a bit more generic. It's not so focused on retirement, but you can ask questions in there. Yes, I'm going to just talk to you about topping up in a moment. What is the maximum service age? There's no maximum service age. You can stay in the scheme up until you're 75. The longer that you are in the scheme, the more your benefits will be worth. Your service is counted in years, months, days. It's prorated, yeah. Is any overtime pay included in your contributions? Yes, you're under the 2014 scheme, under the care scheme, overtime is pensionable. I am a widow and care for my disabled daughter who is over 23. Could I make her a beneficiary? So what you could do is you could nominate her for the death grant so that she'd get that anyway, regardless of her age. If she is actually a long-term dependent, and that situation is not going to change at 23, then please put something in writing to us to tell us about that, and we can keep it on your record. And there may be provision there for a dependent's pension, even though that person might be over 23. But we will write back to you once we receive your letter, so just put something in writing to us. There is a contact form available on the website. I'd be more inclined to put that on a written letter though, with a signature, if you didn't mind doing that, and send it, you know, through the post the old-fashioned way. The postal address is on our website, and it just depends which fund you are a member of in terms of which address you use. Finally, just want to show you on the website where you can find out information about topping up. Because even though, I mean, this scheme really is designed for people who are quite close to the process, so they're probably not going to be thinking too much about topping up because there wouldn't be enough time. But actually, there could be people on here today who might be a few years away from the process, so you may still want to top up. So what you need to do is visit the website, go to members, go to schemes, local government scheme, and then increasing benefits. And you've got APC and AVC there. The APC is an option which allows you to purchase additional income in addition to the one that you've already built up in the main part of the scheme. So it's quite straightforward. If you want an extra £1,000 a year in addition to what you've already got, there'll be a cost attached to that extra pension. The cost is determined by how close to your normal retirement age you are, and there is a calculator on there which will allow you to forecast the cost of that extra pension. Now, you can buy that extra pension using a lump sum, or you can pay for it monthly through your payroll. We've then got an AVC, which is a very different type of arrangement. And an AVC is an investment which is provided by a third party. Normally, well, in lots of cases it's prudential, but there are others, as you can see there. It depends on which fund you are in terms of which provider you have. But what you need to do is find out from this table which one is applicable to you. So if it's Bexley, it's prudential. So you would go down here, you would click on prudential, and that would take you to the LGPS section of the Prudential website. So it's designed for people who want to look at an AVC who are in the LGPS. With an AVC, what you are doing is you are paying into an investment product. That product will have a value attached to it at the end of its life. So the end of its life is when you retire and take it. There's different options in terms of how the money is invested, but you can speak to the provider about that and understand what options there are. And it's payable, if you want it to be, as a tax-free, in most cases, lump sum, in addition to your LGPS pension, but it's paid at the same time as your LGPS pension. If it's not paid at the same time, then there are tax implications. Equally, if you don't want to take it as an entire lump sum, you can take it as additional income. So you can use it to almost buy an annuity, and that annuity can be bought from a provider on the open market. It can be bought from Prudential themselves or whoever your provider is, or it can be bought from us in the form of additional LGPS pension. So that's quite a flexible arrangement. With an AVC as well, if you retire early, there's no penalties for taking it early. Whereas with the other option, the PC, the first one, there would be an actuarial reduction applied to that if you are taking it early. So that's what you need to do if you're interested in maybe paying a bit more in before you finish. Have a look at that section of the website and it will hopefully make those two options a bit clearer. But those are the only two options that you have in terms of anything that you want to be linked to your LGPS. Obviously, you can go out there and set up a private pension, a freestanding AVC. You can do whatever you want to do, but in terms of being linked to your LGPS pension, it's an APC or an AVC. The more money that you pay in, of course, the more tax relief you get. So the money is not taxable because it's being taken from your salary before your salary is taxed.